In order to start the journey of investing in the stock market, it is important that we understand the basics of stocks. In this video, we will be explaining what exactly are stocks, how they operate, and how you can benefit as an investor. Hello and welcome to MC Stocks, where we go over the basics of investing, the stock market, and any updates on today's latest stocks. My name is Chris, and in today's video, we will be starting off with the most fundamental question. What exactly are stocks? Stocks have many names to it. They're also known as shares. They can also be called equity, but these are all words that mean the same to describe ownership of a company. Each stock is represented by a short letter combination known as a ticker. Each ticker has an associated price, indicating how much it costs to purchase a single stock for that company. That price of that stock can fluctuate based on how a company performs and the demand for buying that stock. All the stocks that are listed in the New York Stock Exchange are available to the US public, and the public can buy and trade those stocks. Now you may be wondering, why would a company decide to allow the public to trade shares of their company? This is an excellent way for a company to fund money without leveraging any debt. Companies can issue a stock to raise money to start up their business or to help pay for their ongoing activities. They can raise their capital by issuing stocks to investors who are willing and able to become partial owners. They can choose to issue stock for numbers of reasons, but they all have to do with long-term success of their company. Now, since we have outlined the basic information of what a stock is and how it is possible to make money from a stock, it is now time to go on how exactly a stock works. When companies decide to go public, they can start to issue shares through a process called initial public offering, also known as IPO. After that, the company stock can be placed on the public market. Stocks can then be bought and sold by investors and to the rest of the US public. A shareholder, also known as a stockholder, can sell their stock at a specific price, and an eventual buyer will buy that stock at that specific price. Investors typically use a form of stock brokerage account like Robinhood, Fidelity, E-Trade, M1 Finance, and many others to buy and sell stocks. The big main idea of owning a stock in a company is hoping that the company's value can increase over time so that eventually when you sell your stock, you got it at a higher price than what you bought it for. How can you exactly benefit as an investor? When a person owns a stock in a company, we call that person a shareholder or a stockholder because they share ownership in the company. Shareholders that have a significant number of shares in a company can have an influence. Depending on how many shares they have and what particular stock they own, they can attend, for example, company shareholder meetings. They can vote on certain issues or proposals that the company would like to address. But those are not typically the reasons why most shareholders invest in a company. Shareholders own stock in a company in order to get a return on their investment, also known as a ROI. Typically, when we buy a stock in the company, we are buying from a shareholder who wants to sell their stock. So as long as there is a buyer and a seller, stocks can be bought and sold. Shareholders are always looking for a way to grow their money through stocks. And the two key ways shareholders make money off the stocks is through company appreciation and through dividends. For the first key way, when an individual purchases stock in a company, we mentioned before that a shareholder can purchase the stock at a specific price. We hope that in the future, we will make a profit off this investment. As long as the company is making good decisions and is becoming successful overall, we will continue to perform well, and the demand of the stock in the company will increase. As the demand increases, the price of the stock would increase. This is what we mean by company appreciation. We are getting a profit when we sell the stock in the long term. There are many factors within the company and outside the company that can determine whether a company is successful. We will go into these details in future videos. The second key way that we mentioned was through dividends. Dividends are just direct payments from the company's profits to its shareholders. Companies take a proportion of their profits and make direct payments to their shareholders. The purpose of these dividends is to persuade people to essentially keep their stock and eventually buy more stock in the future. The company does not really want you to sell their stock, so that's where the ideas of dividends come in. It's important to keep in mind, however, that not all stocks pay dividends. It is up to the company to make this type of decision. As more people keep their stock, the price of each stock will start to go up, and the demand will start to increase. Purchasing and selling stock do not always come with high benefits and returns. They always come with risks. It is very important to know what those risks are. It is very well possible that a stock can go down or fluctuate over time. It is also important to know that there are complex investment plans that investors follow in order to maximize their gains. Such investment plans and strategies will be discussed in future videos. But for now, in closing, we have outlined what exactly are stocks, how exactly they operate in the market, and how you can benefit as an investor. Thank you for watching today's video. Remember to subscribe and hit the notification bell to get notified when we post our next video. Like this video for more content similar to this one, and post any questions you have in the comment section below, and we will address them in upcoming videos. Thanks.